Hi, I'm Tom Dalton. This is the second video in a four-part series on partnership distributions. In this video, we look at proportionate liquidating distributions. In the first video, we looked at how non-liquidating distributions are treated. In a non-liquidating distribution, the partnership lives on along with the partner receiving the distribution. In a liquidating distribution, the partner receiving the distribution is leaving the partnership, or the partnership itself is dissolving. In this video, we are looking at this box, liquidating proportionate distributions. So what's different if there is a termination of one or all of the partner's interests in the partnership? Mainly, there are two differences. First, a loss can be recognized by a partner in a terminating distribution. No loss can be recognized in a proportionate non-liquidating distribution. Further, even in a terminating distribution, the loss can only be recognized if only cash or ordinary income assets, such as unrealized receivables and inventory, are distributed to the partner. If Section 1231 property or capital property is distributed, the terminating partner will not have a loss. Second, Section 1231 property, which are fixed assets of the business, and capital property could end up with a higher tax basis with the partner than it had within the partnership. Let's look at an example. In this example, we see that the land has appreciated to $100,000. The appreciation was allocated equally to each partner in their fair market value capital accounts because their profit-sharing ratios are equal. If the partnership dissolves, each partner is entitled to receive $125,000 fair market value of property, as shown on their fair market value capital accounts. In liquidation, the partnership pays off the recourse liability. The balance sheet now looks like this, and we begin with the distributions. IRC Section 732 tells us to distribute assets in the following order: first cash, then ordinary income assets, and finally all remaining assets. So, first, the partnership distributes $50,000 of cash to Laura, reducing her capital accounts by $50,000. After the cash distribution, the balance sheet would look like this. Second, the partnership distributes the accounts receivable equally to each partner so as to keep this a proportionate distribution. If the partners each have a 50% profit-sharing ratio, then each partner would normally recognize $50,000 of revenue when the accounts receivable are collected. So, if the distribution causes one partner to receive more or less than this 50% share of the accounts receivable revenue, the distribution would be disproportionate. That's a bag of worms we'll look at in Part 3. For now, let's keep everything proportionate. After the accounts receivable distribution, the balance sheet looks like this. Now Laura's fair market value capital account is $25,000, and Robert's fair market value capital account is $75,000. The partners agree to distribute 25% of the land to Laura and 75% of the land to Robert. Laura has no remaining partnership tax basis to attach to the land, so the land's tax basis to Laura is zero. Robert, on the other hand, has a $50,000 tax basis remaining in the partnership interest. Since this is a liquidating distribution, he follows Section 732, and the remaining tax basis of his partnership interest attaches to his 75% share of the land. In the next example, assume the partnership had a series of special profit and loss allocations as well as revaluations in property fair market value by the time the partners decided to terminate the partnership. Notice in this example that both the tax capital accounts and the fair market value capital accounts are different between the two partners. Let's assume that the partnership dissolves and the partners receive their fair market value share of assets. Before the distributions begin, the partnership pays off the recourse liability with cash. The balance sheet now looks like this. Again, IRC Section 732 tells us to distribute assets in the following order: first cash, then ordinary income assets, and finally all remaining assets. So first, both partners receive an $80,000 cash distribution. Laura receives a cash distribution that is $5,000 greater than the tax basis of her partnership interest. She recognizes $5,000 of capital gain income, and her outside basis in the partnership is zero. Robert's cash distribution reduces his tax basis in the partnership to $55,000. Notice that each partner's fair market value claim on the remaining partnership assets is different than their tax basis in the partnership interest. That's not uncommon. If you recall, the substantial economic effect rules under Section 704B require that, in a liquidation, the partnership distributes the remaining assets in the partnership according to the partner's 704B economic capital accounts. So Laura is now entitled to $70,000 of the remaining fair market value of the property, and Robert is entitled to $50,000 of the remaining fair market value of the property. In the second step, we distribute the accounts receivable, the ordinary income asset. Since we want to keep this a proportionate distribution, we must distribute the accounts receivable according to the partner's 50% profit ratios, or $50,000 value to each partner. After the accounts receivable distribution, the balance sheet looks like this. In the third step, we distribute all other assets, which in this case is the land. Laura takes the land to satisfy her remaining $20,000 fair market value claim on the partnership. Since Laura has no remaining tax basis in the partnership, the land has a zero tax basis for Laura. Robert has no Section 1231 property or capital property. He only received cash and accounts receivable. Section 732 doesn't allow him to increase the basis of the accounts receivable beyond carryover tax basis, and he can't increase the tax basis of the cash beyond its value. So the only thing left for Robert to do, if the partnership liquidates, is to recognize a $55,000 capital loss. We only had 3 assets here, and they were all in different categories. How do we allocate tax basis to distributed property if multiple assets within a single category are distributed? We'll tackle that problem in the Part 4 video. In the next video, the third video, we'll look at disproportionate distributions, both current and liquidating.